ratio of liquid asset to deposit, we improved our ratio. So far so good. Nothing looks unusual. The only thing that looks unusual is we have a large proportion of our asset, 25 million out of 55 million of our assets are tied up in long-term bonds classified as held to maturity. Again, I'm going to explain what does that mean in a moment. Okay, so far everything looks good. I'm just showing you how we are looking at a balance sheet. So once we pull SVB balance sheet, I don't have to explain it. It's going to be simplified. That's the whole purpose of it. Now, what is important? Why did SVB or why did Adams Bank invested their money in those long-term held to maturity? Well, for one thing, Silicon Valley did not have any other options to lend otherwise. Well, why not? Because they did not have customers. They have a special type of customers. You're going to see SVB had a special type of customers. They don't lend to regular, in quote, regular people. You're going to see why in a moment. 2, why long-term bonds? Long-term bonds gives you a higher return, the highest return, the high return. Why high return? Because if you lock your money with the government for long term, they will pay you more interest rate. So the longer you are willing to lock your money to purchase long-term bonds, the higher is the yield, the higher is the return. So what SVB was doing, just like what Adams doing, is since they did not find a place to lend their money, which is the bank is in the business of lending money to people, to individual, to businesses, what they did is they chased the yield. And that yield was not really that high. They were earning approximately 1.6%. But the alternative is earning nothing because they did not know what to do with the money. Just like Adams Bank, they just received that additional 25 million and they don't know what to do with it. So what is held to maturity? Well, held to maturity, you don't have to record any unrealized gain or unrealized loss. Now we're going to go a little bit technical and explain the concept. When you have an investment, and that investment in bonds, and that investment is classified as HTM, held to maturity, from an accounting perspective, you don't have to show any gains or any losses that are unrealized. Why? Because bonds go up in value, bonds go down in value. Well, since you are not selling the bond, don't worry about the fluctuation. Why? Because you're going to hold them to maturity. What does that mean? At maturity, the US government will be there and pay you the face value. So from an accounting perspective, you don't have to worry about recording those gains and losses because they are unrealized, and whether there's a fluctuation now, at the end, you're going to get your 25 million because the US government is considered a reliable creditor, or at least we hope so, or at least that's what we see in the near future. You know, if we think otherwise, it's a problem for everyone. So you would report those investments at amortized cost, unless you need to sell them. So here's where the problem comes with SVB. What happened with SVB is this. They had losses in those bonds, which is fine. We had losses. It's not a big deal. We don't have to report them like if they don't exist. Now, why did we have losses? I'm going to explain this in a moment shortly. But unless you are forced. And why were you forced to sell those bonds? Well, if the depositors came back and they want their money, look, there's 45 million in dollars. Right now you have 6.5 million in cash and mandatory reserve. So if 10 million wants their money, you have to liquidate. You have to sell those bonds. If you have to sell those bonds and they are experiencing losses, now you have to report the losses. Now we're going to explain why did that happen in a moment. Now the first question was, I just want to clarify this point. Why did the government did not intervene? Why did the government did not intervene earlier, seeing this picture? Well, here's why. There's an act called Dodd-Frank, and we studied this for the CPA exam. Dodd-Frank used to cover any banks that's greater than 50 billion in asset. And SVB was lower than 50 billion. So Dodd-Frank did not apply to SVB. At some point, SVB was higher than 50 billion. But what happened is the Dodd-Frank Act was adjusted to cover only banks above 250 billion. So the government did not look at SVB as closer as larger banks because the Dodd-Frank Act was amended and the bank will have to be more than 250 billion. So the bank was too small, less than 250 billion. Now, what I'm going to do next, I'm going to explain to you the depositors. Who were the depositors? Who were the depositors? That's important. And why did those HTM lost value? two important concepts you need to understand in order to understand why SVB collapsed. The first one is the customers of SVB Bank. Okay, here we go. Only 2.7% of their deposits, a small percentage of the people who had deposit of SVB were insured up to $250,000. Let me explain this to you. Okay, if you have money in a US bank, the government, they have this program called this corporation, Federal Insurance Deposit Corporation. They will guarantee your deposit up to $250,000. So as long as you have $250,000, you don't have to worry about the bank. SVB, they only had, of their total customers, it means 97.3% of their customers all had accounts greater than $250,000. So their customers, they have a special type of customers, high net worth customers, versus a bank like Wells Fargo. Wells Fargo, 40% of their customers are covered by the FDIC because they have deposits less than $250. Look at US Bank Corp, JP Morgan. But notice Signature Bank in Silicon Valley, which is Signature Bank was brought down after Silicon Valley, their customers are high net worth customers. Who are their customers? That's very important. The customers of SVB Bank, that's the initial, when SVB was created, it was created to serve initial public offering, startup company, venture capitalist. Those people, they have a lot of money and they need to invest them. Their executives, their CEOs, their executives, that's where they deposit their money. In 2021, we're going to see in a moment, in 2021, interest rate in year 2021, the Fed rate was close to zero. And what happened, because the interest rate was low, there was a lot of money. There was a lot of quantitative easing. People had money. Investors had money. So what did they do? They invested all this money. There was a large inflow of deposits at SVB Bank. And we're going to see this shortly on their balance sheet. Okay? This is one picture of it. So you need to understand why did they have suddenly a large amount of money. Two reasons. Interest rate was low, and all their customers were venture capitalists, people with money that they need to invest it. They invest in IPOs. IPOs and their CEOs put their money in which bank? Silicon Valley Bank, because you're going to see a huge spike in their deposits. Now, that's one picture of it. The other picture that you need to understand is the increase in the Fed fund rate. In 22 and 23, interest rate started to go up. Now, what does that mean? Well, when you have a higher rate, less and less people invest in IPOs because they can go somewhere else and earn higher return. One, that's two. IPOs don't make any profit. Initial public offering don't make any profit. So yes, initially in 2021, they started to deposit their money because they got the money from the investors. 22, 23, IPOs, all what they do is they consume cash. Their initial public offering. That initial public offering, IPOs at the beginning, they don't make a profit. They're based on the future. And IPOs don't need loans. So IPOs, they're not going to ask the bank to give them loans. That's why they got the money from the investors. And technology stocks are inverse performance with interest rates. So as interest rate goes up, okay, you have investors have alternative options to invest their money. They're not going to invest in tech companies. So those IPOs were not doing well. In addition to all of that, as interest rate goes up, remember the HTM bonds, held to maturity bonds, the value of these bonds go down. Let me explain. So let's assume in year 2020, interest rate was, just for the sake of illustration, was 1%. And you had $1 million to invest. So you invested this $1 million in government bond and you are earning 1%. In 2022, the government is borrowing money at 5%. Now notice, if you have $1 million, you can take your $1 million and invest the money at 5%. Notice the Fed rate went from 0 to 5%. Now what you do is when you invest your money at 5%, you earn 5%. So what happened to the old investor that invested their money at 1%? They're only getting 1%. The interest rate does not change. So the value of this held to maturity will go down, because if you want to sell this investment today, it's worth way less, because no one in their right mind will pay you $1 million for something that's paying 1%. You can go right now to the market and lend your money to the US government and earn 5%. So as interest rates spiked, So as interest rates spiked, as you can see here in 22-23, those investments in HTM was happy earning 1.6%. They were happy because they had no other alternative. That what happened, the value of those investments went down. No big deal. Even if they went down, remember, we don't have to show the losses because they're held to maturity. Unless we are forced to sell them. In case we are forced to sell them, we have a problem. Okay, this is what we're going to see what happened next. But before we see what happened next, I want to show you that if you look at SVB annual report, page 32, they clearly told us, the auditor told us, SVB told us that this is a risk. Notice here, we have experienced significant growth during 21-22, including deposit growth. We're going to see this in numbers on the next slide. Again, if we experience deposit growth at similar or greater rate than in the past, we may need to raise additional equity to support our capital ratio. Remember, if you have deposit, if you invest the money, you want to make sure that ratio is available in case the people wants to withdraw their money. We have experienced significant balance sheet growth, which we'll see on the next slide, beginning in 2020 through the first half of 2022. Follow with me. Failure to effectively manage our growth could lead us to overinvested or underinvested in our operation, results in weakness in our internal control, and give rise to operational risk, financial losses, loss of business opportunities, and loss of client satisfaction, invite increased regulatory scrutiny, and result in loss of employee, blah, blah, blah. So they were aware, as they're growing fast, there's a risk in growing fast. And they're telling you, we are growing fast. Now they're going to tell you where did that money came from. Much of the recent deposit growth was driven by clients across all segments, obtaining liquidity through liquidity events such initial public offering, secondary offering, companies selling stocks in their company, and they're getting money and they're depositing their money as SVB. SPAC fundraising. Now, SPAC fundraising had a lot of money, and I know a personal individual that works in this industry. He told me, literally, he had $300 million. He does not know what to do with. He was asking me if I need money for my company. I said, right now, I don't, because I have no plan to grow. I don't have a plan to growth, but the point is they did not know what to do with money. And matter of fact, what this individual was doing, I'm just going to call him Matt for the sake of illustration, right? So Matt, what he did, he was looking for businesses that need money. Take our money. We need to invest this money because interest rate was 0. So what he was looking for, at the end, he was looking for companies that build swimming pool because there's a lot of shortage during 2021 in swimming pools. So if you want to build a swimming pool, you would have to wait 6 months or a year. So what he wanted to do to invest that money in these companies so they can grow. So the point is there was a lot of money flowing around. And I'm telling you, I know for a fact from a personal experience because I was offered money. I said, I can't use it. I really can't use any money right now. Venture capital improvement, acquisition, and other fundraising activities during 21 and early 2022. Okay, why? Because interest rate was low and the government was dumping money through COVID when COVID was taking place. Though these liquidity events and our deposit abated over the course of 2022, they started to slow down 2022. We are unable to predict whether this liquidity event will return to elevated levels. So then I said, we're not sure if this is going to stay and whether our prior level of deposit growth will return. And they're saying, look, we don't know if this growth will return. We're going to see on the balance sheet next. Our level of deposit also depends on whether the client determined to keep proceeds from liquidity event and other fund and deposit product with us. So they were aware of that risk. They knew for a fact that at some point, these individuals may take their money out. Okay? Our level of deposit depends on whether the client determined to keep them. Okay?